everyone. Today is Wednesday, August the 13th, and I have a little action, excuse me, in HIMS. I picked up a few shares earlier today. I started with 50, and so right now going forward, we have 30-day IV, implied vol about 77-ish, and the realized over the last 30 was 92. So one might reasonably expect a retracement in realized over the next month or so. Whether or not that materializes remains to be seen. But one thing I can do to possibly not take advantage of it, but participate in that possibility is I can add a call to my long 50 delta, my 50 shares of HIMS, by doing the following. Let's say I go out to the August 22nd expiration, and I'm not really thrilled about selling a 50 call, a call at the 50 strike. But let's say that I did do that. Let's say that I received, well, this is fine. Let's say that I received a $1.60 for it, okay? So the risk profile at expiration of this structure, which is long 50 shares of HIMS, and then selling the 50 call, would leave me long a touch. Note that this 50 call has a delta of 41-ish. So I'd be long a few shares of HIMS, somewhere around 8, 9, 10. And this would be a way to play short volatility. So I would benefit if HIMS went a little higher in price, stayed around 50 between, let's say I did this tomorrow. Let's say I do this tomorrow. So I would benefit maximally from HIMS being at 50, the underlying price, at 50, expiration, not this Friday, but the following Friday, because then I would receive basically full value for the call of $1.60, and I picked up the stock at about 410-ish. I don't remember. All right, 4810-ish. 4810. All right. So I'd have $1.90 times a half. There's 50 and 45, so $95 off of that, plus the $1.60 here, so about $255 ish in that scenario. That's fine. I would prefer if HIMS rallied a bit more tomorrow, so that I can sell, maybe sell a call at a higher strike. It's not necessary, it's not mandatory, but let's just play around with this and say, let's say that HIMS has a favorable move to the upside. Let's just say it rallies $5. So I can sell this 55 call for somewhere around $1.60. So I'll just enter that in as $1.60. Say I do this tomorrow. So magically, HIMS is going to rally while I'm long. Wouldn't that be nice? And then I sell the 55 call expiring August 22nd for $1.60. So that structure, similar to the previous one, just more P&L for me, because in this situation, the stock itself, I get $6.90. So there's $345 plus the $1.60 here. So I would get a little over $500, 505-ish. Yeah, there we go. Well, yeah, 505, which is a few hundred more than the previous position. And again, all of this is predicated on implied volatility decreasing over, in this case, over the life of this call, and this is a big one, as if implied vol decreasing isn't asking for enough. I would need HIMS to rally, and in this situation, it'd have to rally about $5 tomorrow, which it's probably not going to. You never know. It might. It's been moving around a lot. It's very volatile. Recently, it's been very volatile. So it's not completely out of the question. Of course, I can go out in time. So let me go to the following expiration. It's 16 days away. And let me go out a little bit more. Let's do, there we go, 30 days away. Okay, so there's the Sep 19th is the monthly expiration for next month. And let me take a quick look at this, the 55 strike. So let's assume in the next couple of days, HIMS rallies $5. So if that happens, I might be able to sell this 55 for, well, let's say that I sold the 60. Let's say that I sell the 60. So in this scenario, HIMS rallies $5 the next day or two. And that means I can sell this 60 strike. And this is just back of the envelope trader math here for somewhere around 250. But let me give myself a price of, let's just say 230 or 225. Okay. So I'm going out 37 days, or since we're talking about tomorrow or the day after, 35, 36 days into the future. I'm selling the 60 call for 225, and the risk profile has the following matchup. So I would be able to make, in this scenario, $11.90 on 50 shares, plus possibly a couple extra $100 selling the call. And that would bring the possible total profits up by hundreds of dollars. But again, it's very difficult to predict the future, at least with any degree of reasonable or impressive accuracy. So I'm not suggesting that any of this is going to happen. But if HIMS does start to rally and I'm long, I do get to at least price these out and consider it, and consider whether or not I want to do something like this, get short vol. I don't have to do anything, but I might. And I also want to mention that we take a quick look at the description function here on Godel. And let's see. So HIMS has 220 million shares outstanding. Their float is a bit under 200 million. And the shorts, about a third of the float is currently short. Somewhat noticeable because that is not necessarily a huge number of shorts, but it's getting up there. And currently it'll take about, based on their average daily trading volume, HIMS, take about 2.5 days to cover all these shorts. Now, if people continue, or if players in the market continue to short HIMS, then it's going to take longer. It's going to take longer, more time for them to theoretically cover those shorts. And I'm not suggesting that there's going to be a squeeze in this or anything like that. Well, if there is, then vol is definitely going to go through the roof. So I can actually take my time on in deciding when I would want to get short volatility, if at all. But if you're involved in something that's getting squeezed and you're long, well, I don't have to mention that that's probably a good thing for the longs. Anyway, I'll keep an eye on it and see what pops up as a possibility. But to start with, picking up a few shares, and picked up a few shares at 48.10, and I'll take it from there. All right, that's it. I'll catch you guys next time.